Quess Corp then came out with its quarterly numbers. You had the losses narrowing. The margins, though, did come under pressure. Suraj Moraje is the MD and Group CEO at Quess Corp, joining in now to talk a little bit more about the quarterly performance. Thank you so much for taking time out. Let's just talk about the quarter gone by, outlook on your bottom line, as well as your overall revenue growth, because understandably it has been a challenging time.
Well, thank you for having me. We're very pleased with our Q4. If you look at the momentum of the business coming out, despite Q1 saw our revenues drop by almost 20% last year, and in Q4, if you take out the two businesses that have been still impacted by COVID, one is the food business, which is which depends on people coming to the offices, and the second is our training and skill development business, which depends on students coming to school. If you take out those two businesses, our EBITDA in Q4 actually was about 5% up year on year with Q4 20, which was a nice recovery. And you see this secularly across our main platforms. So workforce management grew by about 20% in H2. Our global technology solutions business, the margins are up with the revenues being flat year on year. It's now the #1 contributor in H2 to EBITDA. Operating asset management grew its revenues 5 to 6% in Q4, and we saw that momentum as well. Monster seems to had its highest number of customer acquisitions in several quarters. So across the board, the momentum we're very pleased by. We're also pleased by the cash generation. Our cash generation in FY21 was double that of FY20. With the OCF to EBITDA being at a historic high. So we've been working hard on these things. It's nice to be a net cash company. It's been delightful to pay dividends for the first time. So we think we're onto a good thing.
What about the overall workforce management segment? Profits have been hit here, revenues are flat, and even your operating asset management, particularly the security business, facility management, how do you see that playing out over the next couple of quarters?
So you're very right that I think that year on year, the revenues have actually been flat. But again, I put this in the context of Q1 having dropped by 20%. So if you look at the trajectory, it's very much upwards. Each of these businesses has grown, upwards of 6-7% in Q4. Clearly, with the current wave that hopefully is ending now, there has been a temporary loss of momentum. But I think that if you look at the ability of the business, the ability of the sales, the new customer acquisition, we're actually very hopeful that once the lockdowns are over, we'll start to pick up very quickly again. So overall, I must say we're feeling optimistic.
Okay, interesting. Also, wanted to talk about pure financials here. I'm just looking at your gross debt, and that has reduced to about 516 crore rupees from the earlier 1147 thereabouts. On the back of cash management, improved collections, your income tax refunds, etc. as well. What can you tell us about the net cash position, the utilization, and future debt reduction?
So debt reduction remains very high on our agenda. We think that, by and large, where we want to be going forward is that debt being around, let's say, 0.5, 50% of our EBITDA levels. We do have a new capital allocation policy. We've said that we will distribute approximately a third of our free cash flow generated over the next 3 years back to our shareholders through dividend and buyback. And that speaks for a third. I think the remaining third goes to ensuring that we keep our gross debt at a manageable level and obviously towards growth.
So do you remain committed to the goal of 20% ROE by FY23 and 20% year-on-year OCF CAGR?
Absolutely. Every decision we take is seen through that lens, and we're absolutely razor sharp focused on that.
Now the company has underwent a lot of technology-enabled transformation to make employee productivity more streamlined, things to improve in terms of efficiency and capital allocation. Can you give me an example of how the tech play has changed for you?
Absolutely. Look, I mean, I think that we've discussed in the past, the Indian grey collar space is probably amongst the least productive space in the world, I would think. And we're using technology in two ways. One is to make our own hire to retire process more effective, because every incremental hire we get per recruiter per month drives gross margin for us. And the second is by driving the productivity, the work content of what our workers do. And I'll give you an example of each. So, for example, on recruiter productivity, we've launched Q Jobs last year. It's our blue collar portal. We've hit about 500,000 downloads now. What Q Jobs enables, it's built with a very recruiter-backed lens, using kind of recruiters' intuition to say, how do you make sure that you maximize the percentage of people you hire versus people you contact, what we call the contact to selection ratio. And we've introduced things like pre-screening questions, credentializing, and in some of our key roles, we've actually hit contact to selection ratios of 30 to 50%, which means that in the best roles, for every 2 candidates a recruiter contacts, they actually hire 1. That just drives up productivity tremendously. So that's on the hire to retire side. On the actual work content side, I'll give you one example, Nikunj. Our workforce management tool, Work, is used now. I think 80% of our security guards use it to log attendance. But one of the things we have now is this feature called Digital Supervisor. One of the pain points that people have with security guards is sometimes they fall asleep at night. So what Digital Supervisor does is it randomly pings our security guards at night, asking them to solve a puzzle or do a task. And we measure how long they actually take to respond, and that gives us a sense of how alert they're being. So we're trying to embed technology into everything we do to improve the quality of our outcomes and improve the productivity of what we're doing.
Okay, fair point. My next question is that how much of your business currently is still what could be called as a basic staffing business, which is that you just provide an employee and that's a very basic business. Well, how much of a business is where you've managed to really move up the value chain? The same service 3 years ago, you were, let's say, commanding X premium. Now the premium has moved to, double X or triple X.
So I think we're just starting on that journey. I don't want to overplay it. If you look at our workforce management business, that's about 45% of our EBITDA. That is mostly staff augmentation, where we get paid per FTE. If you take our operating asset management business, another 20% of our EBITDA, I would say at least half of that is where we're not doing managed services. So if you look at the overall mix, maybe about 50% of our work is on a per task basis, and 50% is on a per person basis. We are driving this shift, and we're running a lot of interesting pilots, even within our traditional workforce management business, which has been on a per FTE basis. Some of this is driven through our investment in Taskmo, the digital gig company that we invested in January this year. What they do is they accept per task request from our customers, and then they pay back to back on a per task basis also to taskers. And so that is growing quite nicely. But also in our main general staffing business, for example, we're increasingly accepting encouraging terms where we use some of our technologies and tell our customers, look, you pay us per person, but pay us an additional upside if we're able to drive more productivity. And those are early pilots, I would say, but so far very encouraging results, Nikunj, and we're looking to scale this up in a prudent but aggressive way.
To go on that note, appreciate your time, Suraj. Thank you so much for joining in with a snapshot of what the overall environment looks like, as well as your business, driving tech, etc.